Hello, I'm Gary Stringer, Senior Portfolio Manager at Sheldon Capital Management. Welcome and thank you for joining us for our August 2026 Review and Outlook presentation. Now, regardless if you're watching this video or listening to the audio podcast, we thank you for your time and we appreciate your interest. In this presentation, we provide a brief summary and an explanation of our current economic and market outlooks. For more details, please contact your financial advisor. And thank you again for joining us. The theme for this month, for August 2026, is Beneath the Headlines, an economy in transition, not in trouble. We talk about this quite frequently, that there's a lot of noise in the economic data, even though the U.S. Economic data that we receive from, say, the federal government is really the gold standard internationally, globally. But it is a motley set of data in general. You're talking about an economy that's $30 trillion in size or more, 160 million people in the labor force. It's just a lot to get frequent updates on. And it's important to understand some of the nuances behind or beneath the data. And so we're going to talk about some of that today because we have some pretty interesting economic reports recently. For example, with respect to our broad outlook, the July jobs, the headline number was a reduction in payrolls of minus 23,000 plus downward revisions of 103,000 combined for the prior 2 months. That's a big deal, but there's some things beyond that we want to understand as well. For example, layoffs actually are a better predictor of the near-term economic outcomes, and layoffs have actually been historically low. And job openings in general remain plentiful. So this looks to us, and we've been talking about this a lot lately, it's more of a labor supply issue rather than a demand for workers, a setback. In our view, our work suggests that we just don't have enough workers in this country. And that's gonna affect the data that we see. When we think more broadly about this, our 4-factor recession tracking model that we update twice a month as the new data comes out, all 4 factors are positive for the first time in months, as real or inflation-adjusted personal income turned positive year over year in June. And so in aggregate, the risk level we think for the U.S. economy is low currently. Another headline number that got a lot of attention was the headline GDP number that came out for the second quarter that showed that the economic growth slowed to 1.5%. Our work suggests, when we dig a little bit deeper, we like to look at final sales to private domestic purchasers, which strips out a lot of the noise around net trade and inventory changes and so forth, show that the economy actually accelerated. The most important part of the economy, in our view, actually accelerated in the second quarter, not decelerated. And lastly, when you think about market volatility, we saw a jump in volatility in July. A lot of this has been driven by what's going on in the Middle East, the price of oil and so forth. But we've seen sort of V-shaped recovery. Every time we see an equity market pullback, it comes right back strongly. We think that the real reason for that is the underlying economy is actually in pretty good shape. Earnings are strong. Corporate revenues are strong. Consumers in general are pretty healthy. There's pockets of weakness, of course, but in general, things are actually doing okay. And that's not the kind of thing that gets a lot of headlines, but we think it's important for investors to understand. So let's consider, for example, GDP, gross domestic product. We look at that, of course, but we actually like to focus in on final sales to the private sector. And what this does is it strips out the effects of net trade and the changes in government spending and so forth. It just really focuses on what's going on with household spending and consumption, what's going on with business investment. And what we can see is, we've been talking about this a lot, the headline GDP numbers actually, we think, underestimate or understate the strength of the economic momentum. So as the headline number, as I mentioned, actually showed an economy that slowed from 2.1% annualized GDP growth in the first quarter to 1.5% annualized growth in the second quarter, we think that underestimates or understates the actual growth momentum, because actually real final sales, so after adjusting for inflation, to private domestic purchasers, so these are just businesses and primarily households in the United States, actually accelerated from 1.7% in the first quarter to 3.9%. It's almost 4%. Now, these are preliminary data. We'll likely see revisions in the data, but the trend we think still holds. The economy is actually doing rather well, all things considered. In fact, we can look at it globally as well. they're organizations that survey businesses around the world, and companies compile this information so we can see how do businesses feel or think about their supply chains, their order book, how much business do they have coming in, what are their hiring intentions, and all this data gets combined, and then we could actually look globally how things are going and rank countries by their relative strength according to these surveys. And the economy globally, the global economy is doing okay. Some countries are stronger than others. Speaking of strengths, the U.S. of the major global economies, in the JP Morgan survey, for example, the U.S. ranks second in July, second behind only Spain, and well ahead of the global average, well ahead of the Eurozone as a region, well ahead of China and Russia and some other countries. So the U.S. is actually doing rather well, not only just on its own, but also relative to other countries. And this explains a lot about our positioning and how we are invested in our portfolios. So that leads me to our investment implications. We continue to be overweight equities or stocks versus bonds in our allocations, and we have a tilt towards the U.S. businesses, U.S. equities over foreign. We've been maintaining these overweights in the U.S. to really take advantage of what we think are productivity-driven gains, but a broadening also of the opportunity set. It's no longer just the Magnificent Seven, mega cap type names. So we're favoring areas like healthcare providers, industrials, the industrial sector, regional banks, as well as semiconductors and electronic equipment. We remain underweight non-U.S. equities, primarily due to our less exposure to Europe and China. On the fixed income side, yields have been moving higher. That suggests to us that as interest rates have moved higher, bonds actually look more attractive now than they did at the beginning of the year. But we don't want to take a lot of interest rate risk there. We do think there's some potential risk for long-term interest rates to move significantly higher from here, or we're just not getting compensated for that risk. So when we think about our fixed income portfolio positioning, we're concentrated mostly in the middle of the curve, what we call the belly of the curve, of the yield curve, with maturities of a focus of around 2031, 2032. We think we can capture some nice risk-reward trade-off there without taking on too much interest rate risk, interest rate sensitivity. Within alternative investments, we continue to find meaningful opportunities there in areas like multi-asset real return strategies that are kind of commodity tilted, for example, designed to do well in an environment where you might have higher energy prices, for example. We also complement that with these equity options overlay strategies that help to generate additional income and mitigate the risk profile on our portfolios. Now, lastly, with the cash indicator. The cash indicator, which is our proprietary quantitative tool that overlays everything that we do, is designed as a signal that alerts us to times of real potential economic risk that could damage portfolios in a big way. The cash indicator, the level of it continues to bounce around kind of to below the median, kind of lower end of its historical range. And we've actually seen some of these spikes in equity market volatility, especially in March and July, with what's going on in the Middle East when you had these big swings in the price of oil. The cash indicator alerted us to these types of risks that were rather obvious, but also suggested that these weren't going to be systemic risks to the economy and the markets more broadly. So it's actually, as things have kind of settled in, the cash indicator has settled back down. And we're seeing that also on the fixed income side in the credit markets, where we've seen some repricing of risk, especially at the lower end of the credit spectrum. So think of like junk bonds and high yield bonds. There's some repricing of risk there, but nothing really systemic across the fixed income space. So in aggregate, the cash indicator has performed as intended this year, helping us look past the noise of these headline-driven volatility spikes and identify that we actually still want to be leaning into equity and credit risk in here, and we don't want to be overly defensive. And you can see how the cash indicator over time, how it does move around, but only rarely does it suggest there's times where you want to get very, very defensive. And in our view, now is not one of those times. So long as the economic backdrop remains, we think, rather positive, we want to take advantage of market volatility when it presents itself. And with that, I will close by again thanking for your time. If you'd like any further information or have any other questions, please contact your financial advisor. They'll be happy to help.